Hey, what's up, guys? Welcome back to the channel. Today, I want to talk to you guys about a cap rate. What is a cap rate? I've had some questions on that. And it's actually a really good thing to understand when we're talking about marketable rental properties that you're looking for. I know a lot of this channel has been discussing real estate investments on the flipping side, so residential real estate, buying real estate, rehabbing it, and then putting it back on the market for sale for a profit. The flipping term comes from flipping it over. And we've talked a lot about that, but we're also want to get into buying and holding properties. So like the stock market, you can play options, but you can also buy shares of stock and hold them for the long term. That's a long-term investment. The same should be looked at as far as real estate investing and looking at rental income as a part of your portfolio. So I want to talk about that and how to figure out what is a good purchase. I know we talked about ARVs and after repair values and comparables and all that. And understanding what a cap rate is an important thing to grasp when you're looking at real estate investments on the commercial side. And when I say commercial side, I'm not just talking about office buildings, strip malls, but I'm also talking about apartment complexes, multifamily units that you can look at as a long-term hold for your real estate portfolio as far as investing is concerned. So without further ado, we're going to get into the cap rate and what a cap rate is. So basically, definition of a cap rate, which stands for capitalization rate. It's often called the cap rate, is the ratio of net operating income, it's the NOI, to your property asset value. It represents, what a cap rate does is it represents the level of risk on the investment, and the cap rate itself depends on high demand areas versus low demand areas. So the same thing as residential real estate when you're trying to figure out a neighborhood to flip a home and you want to find a neighborhood where people want to live. And if if it's in a lower desirable area and you're still going to be flipping the home, then the prices are going to be cheaper on the front end when you purchase it and then cheaper on the back end when you go to sell it. Same thing would apply on a capitalization rate. In a lower demand area, you want to take a lower risk, at least in the short term. And as things like gentrification come into play, that can turn around and raise your cap rate later if you're looking to sell it because your demand goes up for those areas. So if you're in a high demand area, you're going to end up taking more risk because you got to pay more for the property. And I'll show you exactly what all of that means, okay? So when you have to figure out a capitalization rate, there's actually a formula, and that will help you determine this high demand versus low demand area and figure out the value of the property if you're working it backwards. So all of this comes down to being able to use pro forma sheets. And those are spreadsheets, which you're going to see right here, okay, that have a lot of data in them that are similar to you using a budget sheet or the spreadsheets that I provided to figure out your flip construction costs and your after repair values, okay? So those pro formas, when you're looking at a property for sale, if it's marketed for a multifamily purchase or a commercial office building, retail, strip center, warehouse, whatever it is, they have rental income with them. So that's how you determine, part of what determines the capitalization rate. So when you're looking at those properties, you are going to have a pro forma sheet that's provided to you by the listing agent, broker, whoever it is, that even the owner, it's giving you this information. And most times they'll have obviously a list price of what they're trying to get for their property, but they'll also be showing on some level a pro forma sheet, which has rental income in there. And then it'll have a value, purchase price or an ask price on the property, okay? And what you're trying to do obviously is figure out, is that the right rate? And they're going to have their own cap rate in there because they're going to show what they're supposedly making on rental income, and they're going to be showing what they want to sell the property for. So that determines their, what I call hoity-toity cap rate. So that's what they really want it to look like. And there's definitely some due diligence that you have to do once you get this property under contract. And again, going back to the cap rate, this is the first piece you want to try and figure out, even really before you start making offers. Okay. So the cap rate itself, the formula is the net operating income divided by the value or the appraised value or assessed value of the property itself, okay? So really it's going to be your net operating income divided by value. So that's either the purchase price, the sold price, whatever it is. That value is determined the same way you would in residential real estate. It's a comp. It's a comparable market analysis to get to that value. So this number divided by that number gives you a cap rate, okay? And you see all these numbers sitting here. Don't fret yet. We're going to go through it. I'm going to give you an example. I'm going to show you the pro forma, and we're going to run through that scenario, okay? So what is NOI? Once again, NOI stands for net operating income. You got to be able to determine what a net operating income is, okay? It's the calculation used to analyze the profitability of income-generating real estate investments, okay? NOI is a before-tax figure, so that's before income tax, okay? Appearing on a property's income and cash flow statement, or pro forma, that excludes principal and interest payments on the loan. So you do not include your mortgage payments into your calculation of NOI, and that is going to be your gross income minus your vacancy, and we'll go through this in a minute. So you're basically taking gross income minus operating expenses to get your net operating income, okay? Right here. And there's a lot of numbers that'll be involved in the real world to be able to get from gross operating income to net operating income, okay? To be able to get that number to figure out your cap rate, okay? But part of your operating expenses does not include your mortgage payments. Those are not operating expenses because you're basically paying into the value of the asset. Okay, so that's not an operating expense that you're gonna try and figure out for NOI. Okay, that does not incorporate operating expense. So when you're doing a pro forma, that has to be net of your net operating income. Okay, that's calculated separately. All right. So calculating NOI, once again, gross income, okay, minus your vacancy, which is a vacancy rate that's plugged into your pro forma. Okay, that's the amount of real estate within your investment that is not being rented at the current time. Generally, everybody wants to have a 100% tenant rate or a 0% vacancy rate, right? You want to have your building full at all times to maximize your profit, your rental income. That is very rare, although in this economy right now, this real estate market, most of the country is experiencing very close, if not all, 0% vacancy rates. Now, with COVID and the whole corona crap, that on the commercial side is changing drastically and very rapidly because people are forced to close down. You guys kind of know the scenario. Tenants can't operate if they're not open, which means they're not making any money. If they're not making any money, they can't pay their rent to the landlord. Can't pay the rent to the landlord. They either close down and leave, walk away from the lease, or the landlord is eating it and letting the tenant stay and stay there for free, not paying rent until a time in the future when things open back up. Let's hope that happens sooner than later, because right now the entire market's getting slapped in the face on that end because of that very scenario. So vacancy rates are going to go up. That's going to effectively change your rental income, obviously, and then effectively change your gross operating income, which down the line is going to change your NOI on your properties. I know plenty of people in this market right now where their NOI is 0 or a negative number right now because of those scenarios, okay? But simple terms, you're going to have a vacancy rate on some level. That's going to be calculated in. We'll look at that in just a second. All right, so there's your calculation. So once you get your gross operating income, you subtract your operating expenses, and you come up with your NOI, your net operating income, and then we go to our formula, okay? So here's the example. We're now going to go look at the pro forma sheet to see how I'm going to be able to get that number, okay? So in this case, we're going to try and determine what we should sell the property for, but we have all these numbers already, okay? So this building example is 14,000 square feet in total of rentable space. The rent per square foot, if you divide it all out and do the calculations, is $15 per square foot. We have an other income number in here for the building data. That includes HOA fees, other serviceable, basically reimbursed expenses that come in that we're not actually paying for in our operating expenses. Okay, so that's calculated into this number here. I have in year one, because we're doing this pro forma to an estimate, year one vacancy rate of 9%. So we're assuming 9% of this building in the first year is going to be vacant, which is there's no income for 9% of the building, okay? So now we have, because all these numbers tie into my pro forma sheet on the next page, we have a potential rent income of $210,000 a year, okay? You subtract out your vacancy or your credit loss, so you take 9% of that out of your rental income. Your effective rental income then becomes $191,000, and that's your gross operating income. Now we're going to go into our operating expenses, okay? So all of these things right here, operating expenses, those are all the things you have to pay for. Insurance, property taxes, CAMs or common area maintenance, snow removal, landscaping, water, sewer, all of those things, repair, roof repair, subcontractor, electrical upgrades, mechanical upgrades and repairs, all of that stuff is operating expense, okay? So I know I just flipped really quick through there, but this is all of our operating expenses that are in here, okay? It's on a more simple level, but that's exactly what we're having here. So property taxes, insurance, maintenance, management fees. You're paying somebody to actually manage, do the bookkeeping, coordinate all of the maintenance, common area maintenance. We're going to put in money for reserves every year for those types of things, roof repair, mechanical, so forth. Other expenses that are included in there that are obviously our operating expenses, less mortgage. As I said, mortgage payments are not in here. So this number minus this number gives us our NOI, $90,500. Okay. Now, for simple purposes, just so you can see it, debt service is your mortgage payment every year. So we have a debt service of $72,400. So your cash flow, what you're actually going to cash flow before you pay income tax, sorry, having a hard time talking today, is $18,100 a year on this potential property, okay? Now, this number here is just calculated by financing data that I have on this spreadsheet, all right? So that's calculated as 6% annual percentage rate, okay, on your loan. Amortize at 240 months. Here's your LTV. Here's all the stuff for your loan. So basically, I've calculated an LTV of loaning on it $1.3 million approximately. Max loan amount here. So initial equity into the property if we're looking at this cap rate. And then there's our debt service monthly, and then there's your debt service annually. That's just a formula that's up here, okay? So that's how we calculate that. That's where we get it. But our more important thing for cap rate is our NOI. So now we've taken our gross operating income, taken all of our operating expenses out. We have our NOI, okay? So here it is again, broken out for you. Gross potential, that's based on our price per square foot to rent the building for a tenant, minus our vacancy of 9%. Here it is again, effective rental income. We didn't put any other income in here, although I have it in the other sheet. That's okay. So just keeping it simple. So our gross operating income was $191,100. Operating expenses calculated, you saw from the other sheet, and that's going to be in here. Now this pro forma will be broken out in reality, with all those expenses all the way down into a big spreadsheet, which would get you this number here. And then we have our NOI calculated here, okay? So going back to this sheet, $90,500 is our NOI. We are looking at a value or a price of $1.65 million on this potential investment. That gives us a cap rate of 5.48%, okay? So here it is. $90,500 divided by $1,650,000 gives us that cap rate, 5.48%. What is that really telling us? What is a cap rate? So we've governed the definition. We've gone through and calculated it. Now, okay, great. I got this number. What do I do with this? I have no idea. Just kidding. What do you do with this? So your capitalization rate is basically, like I said earlier, it's basically assessing risk of the property, okay? So most commercial buildings, you might look at it like a 4 to 5% cap rate in a high demand area, okay? So what this is telling us is there's less risk in this property, okay? Now, for that price, to get to that cap rate, right? So this purchase price of $1,650,000 with the NOI that we're showing, or the rent roll is showing the pro forma is showing, is telling us it's not a very risky investment, okay? It's more conservative. Now, that's for your first property, probably what you want to look at. The higher that cap rate goes, like in an area where it could be up to like 10% or higher, that's probably going to determine that it's going to be in a lower demand area, so a higher risk, but that's also a bigger return on your money, okay? So the higher this goes could potentially mean you're making more money just based on simple scenarios, okay? So this is basically telling your risk factor on the property. It also is telling you how much money potentially this property is going to be making. The lower this is, the slower it's going to build wealth for you, if that makes sense in the simplest terms, okay? So, for example, if we went and said, let's just, for shits and giggles, said we're making the same amount of money, $90,500, and divided by, let's just say it's a $1,200,000 property. Sorry, I'm trying to type with the mic in front of me. It's kind of tough. All right. So we're going to do the same scenario in real time here. 90,500 divided by 1.2 mil. Okay. Your cap rate's now gone up to 7.5%. Okay. So you're actually paying less for the property with the same amount of income. Okay. That cap rate goes up. So not only is it telling us variable risk, but it's also telling us we're going to make more money because we're paying less up front for the property at that same rate, okay? So this actually goes, just so you guys, that actually goes to 7.5%, okay? So growth potential on this, which is money making, is actually going to go up, okay? So that's the basic scenario of what a cap rate is, okay? That's how you calculate it. That's basically what it means, and that's the scenario you want to use to kind of go through and assess these pro formas as they're handed to you when you're looking to purchase one of these properties, okay? I will try and make these available for download on I'll have to figure out what website I'm going to be putting that on. I'm actually about to start a Built by Bailey's webpage, okay? So I know you guys have seen the Bailey Custom Homes construction website that I have. That's for my construction company. I also have my real estate company in their website, Build Beyond Real Estate, so buildbeyondrealestate.com. I have some of that stuff up there as well. But what I'll do is I'll make this available on the Built by Bailey's webpage. That'll kind of help you guys out. So once that goes live, I'll just do a quick little video to let you guys know it went, and just make sure that you subscribe to the channel and hit the bell for notifications, and that way you will find out when this stuff goes up on the new Built by Bailey's webpage. So there it is, guys. That's the long-winded quick version, if that makes any sense, of how you determine a cap rate. Hit me up if you got questions, Shane@BaileyCustomHome.com. You can also DM me on Instagram @ShaneBaileyBuilder. Probably the best way to grab me on some of that stuff. I get a ton of emails every day, and with everything going on, it's just a little bit easier to grab Instagram. So @ShaneBaileyBuilder. Again, make sure you guys subscribe to the channel if you have not. Hit that bell, like I said, for notifications. Like the video, I really appreciate it. The more likes I get, the more subscriptions I get from everybody, the easier it is to get this information out to everyone because it gets a bigger draw. You guys know how YouTube works. Appreciate all the support. Continue with that. Make sure you guys catch the podcasts on this channel and on Apple, Spotify, and Google if you have not. It's also on Podbean, Built by Bailey's podcast. More content to come. That's it for cap rates. And if you have any questions, leave them in the comments below as well. And until next time, guys, appreciate it. Later.
You can see the world the way it really is. Always.